Hey, Ken AG here. Today is Sunday, February 22nd, and in 5 trading days, the silver market faces an exam. Not a pop quiz, not a theoretical exercise, a real, scheduled, unavoidable exam called First Notice Day for the March 2026 silver contract on the COMEX. And I'm going to do something almost nobody in this space does. I'm going to give you both scenarios, the one where stress shows up and the one where nothing happens. Because if you can only imagine one outcome, you're not analyzing, you're hoping. And hope is a terrible trading strategy. By the end of this video, you'll have a day-by-day dashboard for the next 5 days, and one specific signal that will tell you which scenario is unfolding before the headlines catch up. Stay for that. Quick disclaimer, nothing in this video is financial advice. This is education about how the COMEX delivery process actually works, what First Notice Day means mechanically, and what signals indicate stress before it becomes a headline. Your money, your decisions. All right, let me start by explaining what First Notice Day actually is, because 90% of the commentary I see online gets this wrong, and getting it wrong leads to either panic or complacency, both of which cost money. First Notice Day is not a default. It's not a deadline for the exchange to prove it has silver. It's the first day on which the buyer of a futures contract, the long, can formally notify that they intend to enter the delivery process. Think of it like an RSVP deadline for a dinner party. February 27th is the day the host finds out how many guests are actually coming. Before that date, everyone holds a reservation. After that date, reservations become commitments. Now here's the nuance most people miss. Delivery on the COMEX does not usually mean a truck backs up to a vault and drives away with silver bars. In most cases, delivery is a transfer of paper title, a warrant, a warehouse receipt. The metal stays in the vault. Ownership changes on a ledger. This is important because it means the system can process a large number of deliveries without physically moving a single ounce. It's an accounting exercise, not a logistics exercise, and that distinction is what allows scenario 2, the nothing happens scenario, to be entirely plausible. But here's where it gets interesting. Even though delivery is often just a paper transfer, the metal behind that paper has to actually exist. It has to be registered. And registered silver on the COMEX as of the February 20th inventory report stands at 88.19 million ounces. That's the metal sitting on the delivery counter, not the total vault inventory, not the eligible silver waiting in the wings, the registered metal, the silver that has a warrant attached and is theoretically available right now to fulfill a delivery request. And across from that 88 million ounces sits the open interest for the March contract, which converted into ounces represents a significantly larger number. The exact figure shifts daily as positions roll, but the gap between potential delivery demand and available registered metal is the tension that makes the next 5 days worth watching. Now, the system is designed to handle this gap. It always has been. The assumption, the engineering assumption built into the architecture of every futures exchange on Earth is that most longs won't actually stand for delivery. They'll roll their position into a later month, they'll close for cash, they'll take their profit or their loss and move on. And in normal markets, that assumption holds beautifully. 2 to 5% stand for delivery. The rest evaporate. The hotel never runs out of rooms because most reservations cancel. The question is whether this is a normal market. And that brings me to the 2 scenarios. I'm going to walk through both of them honestly, without cheerleading for either one, because my job is to help you read the data in real time, not to sell you a conclusion in advance. Scenario 1. Stress materializes. If the market tightens into First Notice Day, the first thing you'll see is not a headline screaming default. That's movie logic. In real markets, stress shows up quietly and bureaucratically. It shows up as a margin increase. The exchange raises the cost of holding a position, which forces undercapitalized participants to either add funds or close out. It's the exchange's way of thinning the herd before the pressure peaks. We saw this happen in December 2025. The CME raised silver margins and prices dipped shortly after, not because the fundamentals changed, because the cost of participation changed. And when the cost of being in the game goes up, the weakest hands fold first. Think of it like a poker tournament where the house suddenly doubles the blinds. Nobody busted, nobody cheated, but half the table can no longer afford to sit there. The remaining players are the ones with deep pockets and real conviction, and those are exactly the players most likely to stand for delivery. Beyond margins, stress shows up as volatility. sharp intraday moves, widening bid-ask spreads, increased premium between the spot price and the futures price, or the reverse, compression of that spread toward backwardation. Backwardation, for those who haven't heard me explain it before, is when the spot price trades above the futures price. It's the market's way of saying, I need the metal now, not later. Patience has a price, and right now that price is negative. You're better off having the metal today than a promise for next month. When backwardation appears near a delivery date, pay attention. It doesn't guarantee a crisis, but it signals urgency. And urgency near a delivery deadline is the combustion point. There's also a hidden variable this week that most Western-focused analysts are underweighting: China. The Shanghai markets were closed for the Lunar New Year holiday through February 23rd. They reopen Tuesday, February 24th. That means 3 days before First Notice Day, the world's largest industrial consumer of silver comes back online with pent-up hedging demand, accumulated orders, and a price to discover. If Shanghai reopens with aggressive buying, premiums expanding, and physical demand stacking on top of an already tight Western delivery window, the pressure compounds, not because of conspiracy, because of calendar. Scenario 2. It clears without drama. Now here's the scenario that doesn't get clicks but is equally possible and equally important to prepare for. Open interest continues to decline as we approach February 27th. Longs who were positioned for a short-term trade close out. Speculators roll into May or July. Delivery volume on First Notice Day comes in within the manageable range, somewhere the registered inventory can comfortably handle. Warrants transfer, ledgers update. And by Friday afternoon, the financial media runs a 3-sentence story that says COMEX March delivery proceeds normally, and half of Twitter says, see, it was all hype. But here's what that conclusion misses. Even if March clears, the question becomes, at what cost? How much did margins have to increase to get there? How much volatility was required to flush out the leveraged longs? How much registered inventory was consumed in the process? Because if the system spends 30 million ounces of registered silver to get through March, April starts the game with 58 million ounces instead of 88. And the next delivery cycle begins with less cushion, less margin for error, and the same structural demand pressures. The 27th is a test, not a verdict. If it clears, the market didn't prove it's healthy. It proved it survived this round. And surviving is not the same as thriving. A boxer who makes it to the 12th round on points hasn't proven he can't be knocked out. He's proven he's durable. But durable and invincible are very different words. Now let me give you the day-by-day dashboard so you can track this in real time instead of waiting for someone else to tell you what happened. Monday, February 23rd. China is still closed. Western markets trade alone. Watch the spread between spot and the March futures contract. Is it compressing or widening? Watch whether any margin announcements come from the CME. Watch the tone of early week positioning. Monday sets the psychological table for the rest of the week. Tuesday, February 24th. This is the day that changes the dynamic. Shanghai reopens. The INE and SHFE resume trading. Watch for the Shanghai premium relative to Western spot. If it widens compared to pre-holiday levels, that tells you pent-up demand is real. If it narrows, the holiday didn't create a backlog. Tuesday's Shanghai session is your thermometer for Asian physical demand heading into First Notice. Wednesday and Thursday, February 25th and 26th. These are the critical inventory days. Watch the daily COMEX vault reports. Is registered silver increasing, meaning metal is being moved onto the delivery counter? Or is it decreasing, meaning metal is leaving the system right before the exam? Also watch for any announcements from the CME about position limits, margin changes, or delivery procedure adjustments. These are the exchange's tools for managing stress. If they use them midweek, it tells you they see something in the data that warrants intervention. Friday, February 27th, First Notice Day. The number that matters is how much open interest is still standing when the bell rings. Not the deliveries announced on day one, because those trickle in over the delivery period. But the open interest, the remaining reservations. If it's elevated relative to registered inventory, stress is real and will play out over the following weeks. If it's collapsed, the roll worked, the system cleared, and the pressure shifts to the next cycle. And here's the one signal I promised you at the beginning. The signal that tells you which scenario is winning before the headlines figure it out. Watch the ratio between delivery notices issued in the first 2 days after first notice and the total registered inventory. If day 1 and day 2 delivery notices combined exceed 8 to 10% of registered silver, the system is under genuine pressure. Every historical delivery squeeze has shown this pattern. The serious longs don't wait. They file immediately. Front-loaded delivery notices are the fingerprint of real physical demand, not speculation. If that ratio stays below 5%, the system is clearing normally. The hotel has enough rooms. March becomes a footnote. 5 days, 2 scenarios, 1 rule that applies to both. The exchange doesn't need to break to change the game. It just needs to change the incentive. A margin hike here, a rule adjustment there, a quiet shift in the cost of carrying a position through delivery, and suddenly the math that made sense on Monday doesn't make sense on Thursday. That's how the system manages stress, not with sirens, with spreadsheets. And if there's no stress at all, that's not the end of the story. It's just the market saying not this time. And not this time in a market with draining inventories, record industrial demand, and structural deficits just means the pressure rolls forward, the exam gets postponed. But the material on the test doesn't change. Pull the reports, watch the vault data, track the spread, and make your own assessment, because headlines are foam. Inventory is the tide. If this breakdown gave you a framework for navigating the next 5 days, hit the like button. 1 click, and it pushes this past the algorithm to people who are trying to understand what's actually happening instead of what someone wants them to believe. Leave a comment. Tell me which scenario you think plays out, and lie. I read every single one. If you're not subscribed, hit subscribe and turn on the bell. I'll be covering the daily vault reports and delivery data in real time this week. You do not want to miss that coverage. Share this with someone who keeps hearing about COMEX stress, but doesn't understand what it actually means. Give them the framework. Thank you, and as always, build that stack.